Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what do you mean by underlying stock? Answer by Santoshi Chawla. What does underlying mean? Underlying, in equities, is the common stock that must be delivered when a warrant is exercised, or when a convertible bond or convertible preferred share is converted to common stock. The price of the underlying is the main factor that determines prices of derivative securities, warrants and convertibles. Thus, a change in an underlying results in a simultaneous change in the price of the derivative asset linked to it. Breaking down underlying, there are two main types of investments, debt and equity. Debt must be paid back and investors are compensated in the form of interest payments. Equity is not required to be paid back and investors are compensated by share price appreciation or dividends. Both of these investments have specific cash flows and benefits depending on the individual investor. Financial derivatives. There are other financial instruments based solely on the movement of debt and equity. There are financial instruments that go up when interest rates go up. There are also financial instruments that go down when stock prices go down. These financial instruments are based on the performance of the underlying asset, or the debt and equity that is the original investment. This class of financial instrument is referred to as derivatives as it derives value from movements in the underlying. Generally, the underlying is a security such as a stock in the case of options, or a commodity in the case of futures. An underlying example. Two of the most common types of derivatives are referred to as calls and puts. A call derivative contract gives the owner the right, but not the obligation, to buy a particular stock or asset at a given strike price. If company A is trading at $5 and the strike price is hit at $3, the price of the stock is trending up, the call is theoretically worth $2. In this case, the underlying is the stock priced at $5, and the derivative is the call priced at $2. A put derivative contract gives the owner the right, but not the obligation, to sell a particular stock at a given strike price. If company A is trading at $5 and the strike price is hit at $7, the price of the stock is trending down, the put is trading $2 in the money and is theoretically worth $2. In this case, the underlying is the stock priced at $5 and the derivative is the put contract priced at $2. Both the call and the put are dependent on price movements in the underlying asset, which in this case is the stock price of company A. For further strategies or investment-related queries, try Swastika InvestMart Limited to manage your wealth profile. Click here to open an account or feel free to contact us. Answer by Vivek Pathak. Hi. Underlying stock is a terminology used in derivatives. Derivatives are securities which derive their value from the value of the underlying asset. If it's a derivative of a stock, then the underlying asset is a stock and would be known as the underlying stock. For example, if it's a call option on Infosys, then the option would derive its value from the price movements of Infosys stock, i.e., the underlying stock. An example on how derivatives work. Say, Mr. A owns a house worth 3 rupees CRS. He wants to sell the house. Mr. B wants to purchase the house, however currently he doesn't have 3 rupees CRS. Then A and B come to an arrangement, where A agrees to sell a right to B to purchase the house after 3 months at 3 rupees CRS, in exchange of 20 rupees lakhs right now. This right is known as a call option, where B has a right to buy the house at a predetermined price after a fixed period of time. Now, let's say, after 2 months a favorable event occurs, say, a celebrity buys a house right next to the above-mentioned house. The price of the house then jumps to 10 rupees CRS. However, B is holding a right to purchase the house at 3 rupees CRS. This would mean that if B purchases the house at 3 CRS, he can immediately sell it for 10 CRS. However, he can even sell his right to buy, call option, which he had purchased for 20 lakhs, which now may be worth even more, say 1 rupee and 50 paise CRS. However, if an unfavorable event occurs, say the property is declared illegal, then the call option, right to buy, would lose its entire value since B wouldn't buy the house and there would be no one else willing to buy the house too. Since the call option, right to buy, price is moving with respect to the price of the underlying asset, house, it is a derivative. Similarly, there are derivative instruments available in stock market where the underlying asset is a stock, where the price movement of the derivatives are linked to the price movements of the underlying stock. Hope that helps. Cheers. Answer by Haresh Melchandani. The word underlying is used in concept of derivatives. Derivatives, as the name suggests, are the contracts which derives its value from an underlying asset. The underlying asset could be anything. Derivatives are of three types: futures, forwards, options and calls. Underlying stock is used in the concept of equity derivatives. Suppose I say, I want to buy future Contact for 1,000 shares of Infosys. So, in this case Infosys shares would be underlying stock to decide the price at which I can enter into the contract.